Welcome to Grow My Business or Sell It, the podcast that helps entrepreneurs in 3 ways: how to grow your business in the most cost-effective way, how to sell it for as much money as possible, and how to invest the proceeds of all that hard work. Whichever stage you're at, listen up, because I guarantee you'll take something valuable from every episode. Hello and welcome back to Grow My Business or Sell It. And now I've got something slightly different for you in this episode, because I want to talk to you about what you do with the money in your business and how you need to start investing outside the business in order to create long-term multi-generational wealth, which is hopefully why you're doing this in the first place. Because one of the toughest conversations I have with business owners is this idea that the business itself should be like a great big ATM machine. It's there for you to take money out, not to leave money in. And the whole point of this is that you've got what you might call the fast money going in and out of the business day to day as you start doing transactions, you make profits and so on. You need to start bringing that money out and putting it into investments that you could think of as slower money, if you will, where you're actually going to get long-term returns. And the point is not that you'll make more money outside the business than you would if you'd left that money in. The point is that there are 100 reasons why your business could fail in the next 6 or 12 months. If you don't believe that, think about the pandemic. What kind of curveball was that for businesses in the live event space, the travel space, the hospitality sector? They were devastated by the restrictions that were put in place with alarming speed. There was no time to plan. There was hardly any time to react. You had restaurants suddenly trying to do a takeaway service. You had hotels that, if they weren't at airports accommodating people that arrived with negative tests, were kind of out of business. So that was a real object lesson in how quickly things can change. In fact, one of my recent guests on this program said, if you think Bitcoin is volatile, try small business. There are so many things that, we've got this perfect storm at the moment now with supply chain issues, with record high inflation, rising interest rates, people walking away from the workplace and deciding that they don't want to work anymore, so you can't get the staff. So the number of issues and challenges facing your business is increasing, and a lot of them are coming together and probably going to threaten a lot of established business models as to whether they can survive in a time of high inflation, increasing capital costs, scarcity of labor, and supply chain issues all around the world. So, factor that in, and it's hopefully dawning on you that you have to use the good times to take money out of the business and have some kind of investment cushion where you're accumulating assets that are not relying on the continued operations or the continued profitability of your business. So what I want to do in today's program is to talk you through a structure that I've created over the last few years, which I call a wealth pyramid. And it's a way of understanding all the different types of asset you can invest in and the different jobs that they will do for you, and why you need to start building a portfolio that has all of these kinds of assets in it. Now, a lot of people I talk to, particularly in the UK, they've got a history of investing in bricks and mortar. And so they've got lots of buy-to-let properties and very little else. What I want to try and show for you is that that's fine as one part of your portfolio, but you need some other stuff as well, particularly in times like these in the 2020s. I've been saying this will be the age of uncertainty for 2 or 3 years now. I must be honest, I didn't expect a global pandemic or a war in Europe, and it was still already going to be an age of uncertainty. So now it's more like an age of complete and utter fear, uncertainty, and doubt, a FUD factor decade, if you like. I have no idea what things are going to look like in 2030. I know that there's some government policies heading towards 2030 that are already looking like they're completely out of date and obsolete, particularly things like net zero and so on. But what matters is, how are you going to build wealth during the 2030s? The 2020s up to 2030, and then you put yourself in the best position by the end of this decade to actually survive and thrive. So I want to talk about this concept of the wealth pyramid. Now, the first thing that actually might be a baby step you could take if you've not already done this is to open a separate bank account that's not the one in your business, nor is it the main personal account that you pay your mortgage and your groceries and everything from. I want you to make sure you have a dedicated wealth account. So just open it up. If it was mine, it would be the Graham Rowan wealth account. If it was yours, it would be the John Smith wealth account. And just have a separate account whose sole purpose is to receive money from your business in order to then start making investments. Now, to help you understand this wealth pyramid concept, especially since this is an audio program and it's quite a visual concept, I would really encourage you to pause listening to me now and to go and download an example of the wealth pyramid, which you can do at my website, grahamrowan.com/pyramid. So if you go to grahamrowan.com/pyramid, you can download a visual of the pyramid and some instructions for how to complete it. And I think that will really help you as I take you through what each of the different elements, what the different 4 layers are, and what kind of assets live within each of those layers. So why did I choose a pyramid? Well, several reasons. Firstly, it's got a very nice kind of pointy shape with a broader base at the bottom, which is effectively the strong foundations you're going to build your portfolio on. It's also quite easy to think of a pyramid being kind of sliced in vertical layers so that you can understand one sitting on top of another. And of course, those layers get narrower as you go up the pyramid, which implies something to do with what they call asset allocation and how you would actually spread your incoming funds across the different layers of your pyramid. And I suppose the other thing psychologically is that pyramids have survived for hundreds, if not thousands of years. And therefore they have that kind of multi-generational feeling of permanence. And this is the point that I really want to get across, if nothing else, from today's program, that this is all about a kind of transfer process where you're taking money out of a volatile but hopefully profitable business and putting it into a much more stable, thought through, planned out pyramid of assets that will look after you for the rest of your life and be capable of being handed on to your children and your children's children. That's what we're talking about here. So I hope you've been and got your wealth pyramid download. If not, if you're jogging in the park or driving the car while you listen to this, it's a fairly easy visual. Just think of the triangular shape of a pyramid, and we've got 4 layers in this pyramid. The layer at the bottom, the biggest layer, the widest foundation, is the one we call the bedrock layer. And I'll talk in a moment about the purpose and the assets in your bedrock layer. The next layer up, moving up from there, is the passive income layer. And then above that one, we have the global diversification layer. And at the pointy end of your pyramid, we have the high velocity layer. So you've got bedrock across the bottom, you've then got passive income, you've then got global diversification, and then at the top, the pointy end, is the high velocity layer. So we're taking money out of the business on a regular basis, we're putting it into our wealth account, and then once we've started accumulating some money, and that could be 10,000, 50,000, whatever it is, then you start being able to invest. So first, you get into the habit of saving. And I don't care what your background is, if you can't live within your means and save, you'll never be wealthy. And it's a discipline, it's a psychology. And frankly, if you can't save when you're on 10,000 a year, you won't suddenly become a saver when you're on 100,000 a year or 500,000 a year. It's a mindset, it's a discipline, it's part of financial education. So the discipline I want you to get into is to agree a percentage of your income. And by that, I mean every time you get money into the business through an invoice being paid, through dividend being declared, whatever it is, a salary, whenever you get an amount of money, you take a certain percentage of it, and that goes into your wealth account to be part of your investment pyramid. Depending on your age and your circumstances and what other assets you've got, this could be 10, 20, even 30% of that income moving across to the wealth account, accumulating there. Don't worry about the crappy interest rates. That's irrelevant. The point is the discipline. And you start building up that money in your wealth account. It's not there for holidays. It's not there for a car. This is there to invest in multi-generational wealth. So we've then got to start thinking about this wealth pyramid. So let's start with that bedrock layer across the bottom of the pyramid. The sorts of things we're trying to do here are really to retain the purchasing power of your money. And the thief that comes in the night is inflation. And if you're under the age of 50 or even 60, you probably have no real concept of inflation because we've had such a benign environment for so long that the idea of double-digit inflation is something you read about in history books. But it is so powerful. Official inflation figures massively understate the real phenomenon that's going on. So, for example, at the end of 2021, the official inflation figure in the UK was, I think, about 4-point-something%. So I went and had a good old rummage around in the Office of National Statistics website, and it's all there. And I actually looked at inflation in real things that real people do, like heating their homes, driving a motor car, buying food, all sorts of really, controversial, wacky things like that. And the reality I found in December 2021 in the UK, for a normal family doing normal things, inflation then was more like 15%, 15%. Today, with official inflation at 10%, that figure's probably more like 20, 21, 22%. What that means is every pound that you have in the bank or in savings is losing a fifth of its value a year. So it would be gone by the end of this decade. It would be worthless. So you can see why taking no action to protect yourself from inflation, it means you're going backwards at the rate of 20% a year. You could have what appears to be a profitable business in nominal terms, but in real terms, after inflation, you're losing money. You could make 15% in your business and think, hey, I made 150 grand profit this year on a £1 million turnover. The reality could be that it's lost 150k of purchasing power within the next 12 months. That's how powerful this concept, this villainy of inflation really is. And when you hear the central banks boasting about the firm action they're taking to address inflation, and that's why the Bank of England has now put interest rates up to perhaps even north of 1%. Well, hold on a minute. 1% nominal rates with a 10% inflation rate, that is actually minus 9% is the current Bank of England base rate. That is not fighting inflation. It would need to be put up to 10, 11 or 12% to fight inflation. And if you go back in the history books to the 1970s, when inflation was last at this level, that's where interest rates were. You could actually get 12% on money in the bank or the building society then, which seems ludicrous to people today. So we're now in a situation where we have these massively negative interest rates. We have your purchasing power losing 10, 15, 20% a year if it's just sitting there in cash. So the bedrock layer of your wealth pyramid is all about how to prevent that. So what kind of things can help you to keep your purchasing power in a time of 40-year highs of inflation? Well, one of the obvious things that's always been a kind of inflation protection and your friend, if you like, is gold bullion. And this is something which A lot of people are critical of, a lot of people say because it pays no interest or no coupon, it's, barbarous relic. Was it Warren Buffett called it that? Yeah, okay, I agree it doesn't pay any money, but that's not its purpose. Remember, what we're talking about here is what is the job of each of the assets in your wealth pyramid? Well, the job of gold is just to sit there. And what happens is gold doesn't change. It just sits there. What changes is the amount of paper currency, whether that's pounds, dollars, euros, that you need to buy an ounce of gold. At the moment, as we record this, it's about $1,800. If the dollar weakened further, that could go up to $2,500. The point is, gold would reflect the same purchasing power in 5, 10, 50 years' time as it has today. The classic example that gets used is that an ounce of gold would have bought you a centurion's outfit in Roman times. 2,000 years later, it would buy you a decent suit on Savile Row. Whereas if you had some pound notes from the 1950s or something, £1,000 then, it's probably worth about 50 pence today. So it's the purchasing power has all but disappeared. So gold is an important part of what you would hold in your bedrock layer of your wealth pyramid, and I prefer the physical stuff. Rather than paper gold in ETFs. You never quite know if they've got all the metals to cover if everyone suddenly wanted to get the access to the gold in a hurry. So the sorts of things I've used are gold Britannias, which are legal tender and therefore not subject to capital gains tax. I've bought them from people like Bullion by Post. I've also used allocated gold in vaults in places like Zurich and Singapore. I've done that through platforms like bullionvault.com. Now, with that one, you don't take delivery of the gold, but you could actually go there and pick it up if you wanted to. And it's very easy to buy and sell online. And it's better than a paper ETF, but it's not quite as good as having it sitting in your safe or buried in a hole in the garden somewhere, hopefully, that you can remember. If you do want to keep it in a safety deposit box, I would urge you to do so outside of the banking system, because in the same way as they can switch off the ATMs at the flick of a button, they can also deny access to your personal safety deposit box if it's held in a bank. So I would go outside of the banking system to a private company where they're not under the control of the banks, who are themselves pretty indirectly, but under control of the politicians. So gold is a key thing to hold. Very easy to get in and out of, very low entry-level costs there to start building up some coins and some allocated gold in London, Zurich, or Singapore. No excuse for not doing that one. It's so easy. I would also actually, and there's some controversy a bit around this, I would put your main home in the bedrock layer. If you've read Robert Kiyosaki's Rich Dad, Poor Dad, he talks about your house being a liability rather than asset. From a cash flow perspective, which is obviously what he focuses on, I agree with that. Obviously, it costs you money to live there. But for most people, the main home becomes one of the main sources of wealth. And because they tend to go up again, as inflation eats away at the value of the currency, it takes more pound notes to buy the same house. That's why average house prices generally keep on going up. So I think that it is actually a good store of value and should have a place in your bedrock layer. I'd also put some real assets in here, things like fine art, classic cars. These are things which, the markets do go up and down a bit. A Picasso might vary in value a bit from one decade to the next, but they ain't making any more of them. And generally, these things do tend to keep their purchasing power and sometimes to increase significantly, especially if they're kind of rarer models. Now, you need obviously either expertise yourself or some expert guidance in buying the right classic cars. There are plenty of people out there who are faking Ferrari 250 GTOs and things. You've really got to know what you're doing. This is where people like my friend Ian Tyrrell are very helpful. They can assess the history of a car and tell you if it's genuinely what it claims to be. But when you look at some of the values on some of these Ferraris and Lamborghinis and things, they are going to hold their price very well into the future. And again, with fine art, and even the definition of fine art continues to vary. If you look at, say, Andy Warhol's work and how that's gone up in value in recent years, Jeff Koons, there's plenty of art that you can look at investing in. But again, you need expertise, because there are people out there who will try and convince you that such and such is going to be the next big thing, and it perhaps might not turn out quite to be that way. I would also put private equity investments in this layer. Now, they are essentially medium to long-term investments in companies that are not on a publicly quoted stock market like the FTSE or the New York Stock Exchange. This is where increasingly a lot of value is being created these days. Certainly at Beaufort Society, we're all about private equity. It's the main thing we do. We find interesting companies who've got to a certain stage. They're looking for some growth capital, and they have the potential to increase 5-10 times in value over the next 3 to 5 years. They tend not to throw off dividends because they're in that growth stage. They're reinvesting all of their income in growing the business, but they tend to also potentially have very significant capital gains, and you can exit with perhaps 10 times what you put in. But it's patient money. You have to be prepared to leave that money in there. Usually very hard to sell those shares, but tremendous gains. And private equities outperformed public stock markets over the last 20 years. I have a separate paper coming up on that you can get hold of through Beaufort if that's of interest. Controversially, I would also put Bitcoin in this layer if you're buying it and holding it for the long term. Yes, I know it's been volatile. I know as we record this in July 22, Bitcoin has halved in value this year, but it's done that many times before. If that's the sort of thing that worries you, then you definitely don't want to be investing in Bitcoin. But if you can take the same view of Bitcoin as you do for private equity, that it's a 5-year view, it's something where it could easily go up 10 or 50 or 100 times, or it could go to zero. That's always the risk with something like that. But it's a long-term hold. And a long-term hold with an indefinite, uncertain outcome. But my argument is the allocation you make to it might only be 1% or 2%, probably shouldn't be zero. Because it's got such potential for massive returns, what some people call asymmetric returns. Yeah, there is a risk of it going to zero. I think as the years go by, that risk gets less and less. But there's also a possibility of it going to 500,000 or 1 million or whatever. None of us can predict where that's going. I know lots of gurus like to put these big numbers on these things, but I would argue a bit of Bitcoin tucked away in your bedrock layer makes a lot of sense. The other sort of thing I would put in here is probably some emergency cash reserves, just to get you through 3 or 6 months if you have had a problem with the business, and you needed to just put food on the table for a while. So I would just keep some emergency cash available, again, outside the banking system. We all know what happened in Cyprus and Greece in, was it 2014, 2015? Quite scary. We've seen it in Russia recently as well, and in China. Runs on banks are not pleasant. Having enough to put food on the table for 3 or 6 months will definitely be something that will help you to sleep easier at night. So that is the bedrock layer. It's not there to throw income off. It's there to preserve the purchasing power of your money in real assets like gold, your main home, art, classic cars, Bitcoin, private equity, etc., etc. Next layer up, the passive income layer. Obviously, especially if you're going to sell the business at some point, you need investments that are throwing off income that can, pay for the holidays, pay for the car, pay for the mortgage, whatever. So here is where I would put things like the classic British obsession, buy-to-let property. Now, to be honest, the more I speak to serious landlords these days, the more I hear people who are actually reducing their buy-to-let portfolio rather than increasing it. There's been nothing short of a vendetta against private landlords in the UK since the days of George Osborne. It's become a lot harder to make money out of buy-to-let. That will become increasingly the case if property prices stop increasing or perhaps even decrease as interest rate rises feed through the system. We're already seeing in America a massive cooling off in the property market. We tend to catch the same cold here after they've sneezed a few months later. So I suspect we'll see at the very least a plateauing of property prices, possibly a slight decline as more kind of desperate buyers decide they're going to drop their price to get some kind of traction. So without the capital gains, a lot of private landlords' returns would have looked pretty anemic in the last 10 years. So you've got to look very closely at whether buy-to-let property would still work for you. If you've become an accidental landlord because your partner's still got a property that's rented out, or you've inherited one through your parents or something, you need to look very carefully at it and see that it is actually going to make a positive contribution, or could the capital tied up in that property be better invested somewhere else. But that all said, if you're running a profitable, cash flow positive buy-to-let portfolio, this is where it lives in your passive income layer. Also very much where commercial property would live. So I have commercial property in terms of offices, and these sorts of things can provide a very predictable longer term income based on whatever the lease is and the kind of tenant you have in there. Commercial property also quite flexible in terms of being held within pensions where you can receive proceeds tax-free and so on as well. So commercial property that's throwing off positive cash flow is definitely something that fits in your passive income layer. This is where I put bonds as well. Now, government bonds, gilts, you may have heard that term, they've been paying really terrible returns for quite a long time, probably since the financial crisis at least. But because they've been regarded as a safe haven, money has piled into them, which meant the prices have gone up, even though the yield has therefore gone down. So people have actually, it's a little bit analogous with buy-to-let in a sense, that the total return on bonds has come from a bit of income and a lot of capital appreciation as more money is piled into that market. Now, the one thing that kills bond prices is rising inflation and rising interest rates, because the fixed income from that bond, which was established at a time of lower interest rates and lower inflation, suddenly becomes less attractive. If I'm only getting 3% on this bond and inflation is 10% or 15%, I'm making a guaranteed loss. So how much am I going to pay for that bond that's tied into this amount of yield? So I would only buy that bond if I could pay less money for it, so that the fixed amount of income it produces becomes more like 10% than 3%. You see what I mean? So the price of the bond is effectively in inverse proportion to the yield. So if I want a higher yield, I'm only going to pay less money for that bond, because I can go out into the market today and buy a bond that's going to pay me more. So we're now in a period of rising interest rates and rising inflation. So bonds are a very challenging place to be at the moment. That said, if it looks like they're the last man standing and the least worst option, we could still see bond prices start to go up again and yields to go down again. So bonds are a challenging investment, I would say, but they do sit here in your passive income layer. And there are also, of course, as well as governments, companies issue bonds as well. So you can get corporate bonds. And what matters then is, what's the strength of the underlying company? Are they going to be able to sustain these coupons on these bonds and keep paying you your interest? And are they going to have the capital to pay you back at the end? So you need to make sure that the underlying company is very strong. And you'll sometimes hear the term junk bonds. That's usually where they're issued by companies where there's some question marks over whether they're going to survive in the longer term or not. So again, caution is necessary when you're looking at bonds. One of the things that we've done quite a bit of in Beaufort Society are loan notes. These tend to be issued by companies looking for some shortish term additional funding to help them grow their businesses, or to help them go through a particular restructuring of the business. They will have a coupon, so they'll say it's a 24-month loan note with an 8.5% coupon. Sometimes there'll be what's called convertible loan notes, which means at some point in that process, you can switch them from being a loan to being equity in the company. And usually there'd be attractive terms for doing that, because obviously that then removes the need for the company to repay you or to keep paying your coupon. So it's attractive to the company for that to become equity. So you'd often get offered a discount on the share price to convert that loan note into equity. So loan notes and convertible loan notes would also sit here in your passive income layer. But of course, if you decide to convert it to equity, that then moves back into your bedrock layer as a long-term hold where you're going to be looking for a capital gain. And maybe if it started paying dividends in the future, you've got something that actually would also sit in your passive income layer. So shares can obviously be focused primarily on growth or primarily on income. So a dividend producing share, so if you buy Marks and Spencers, or at the moment the oil companies are paying good dividends, the BPs and Shells, the financial companies are paying some big dividends, the mining companies are paying big dividends. So shares that throw off dividend income very much would sit in your passive income layer. And if you can wrap them in some kind of tax-free environment, like an ISA or a pension, then that certainly makes it even more attractive. So anything like that that's going to throw off income sits in this layer. And also you can get into things like syndicated loans, where you might lend money to a property developer, or a group of you might get together and fund a property development project and get paid 1% a month on your money, or something like that, 10% a year, with a first charge over the development. So these are all the kinds of things that would sit in this passive income layer. I suppose you could include interest on bank accounts if you've got a sense of humor here. I think it's, what is it now, about 0.0001%. Normally, I think if you put £1 million in a retail bank for a year, you can probably buy yourself a coffee at Starbucks at the end of the year and celebrate your interest payment. So I haven't really included that in your passive income layer. So let's move up the pyramid now to the global diversification layer. What on earth do I mean by that mouthful? Well, one of the big challenges of investors is they're too parochial. They tend to focus on their home country. A lot of people, you'll find, they've got 80 or 90% of their assets in the UK because that's where they live. That's a really dangerous diversification strategy. In fact, I would call it not a diversification strategy. One of the problems of the traditional financial world and financial advisors is that they tend to think in this very similar narrow framework. And they think that if you've got, this much in such and such a UK income fund and this much in a UK growth fund, then you're diversified. Well, the reality is all countries and all markets go through cycles of where they go up, where they go down, where they go sideways. Almost impossible to time all of those market moves, and a lot of people have lost an awful lot of money trying to time market moves. Far better is to be in lots of different markets so that you catch the up moves in the ones that are moving up this year, and they can hopefully more than balance out the down moves in the ones that might be going down this year. But to have a genuinely diversified portfolio, you've got to think of the world as your chessboard on which you are going to make your moves. Now, this is already true in the business world. You can almost, for many non-brick and mortar businesses, you can practically run them from anywhere on the planet now. If you've got a laptop and internet access, it's amazing how many business transactions you can run. And, I did a Zoom call with one of the companies that we're raising funds for in Beaufort Society at the moment. I did it yesterday, actually. And one of the guys, I was in Portugal, one of the guys was in the UK, one was in Sweden, and one was in Switzerland. And they all work in the same business, but they can all do their jobs from those different countries. And that's the way it's going more and more now. Well, you've got to think the same way about your investment portfolio. Some of the best opportunities are not going to be in the country where you were born and raised, or even in the country where you're now living, or in the country where your business is based. So you've got to start thinking more broadly. And that can mean anything from just having a bank account abroad, having a holiday home abroad. It could mean having a business, setting up a company abroad, give you some geographical resilience. Maybe you could have an office in Dubai or Singapore or something. Just think a bit more broadly about what you could do with this. You can buy shares in overseas stock markets. That would count as living in your overseas layer. So the last time I looked, I think I had assets in something like 9 different countries, and businesses in 3 countries, and bank accounts in 3 countries, and the ability to go and live in multiple places. This is where I would put things like citizenship by investment programs or digital nomad visas, which are springing up all over the place now. Countries want to attract you, your business, and your money. And so they are making it easier and easier for you to live there, have residence there, have favorable tax regimes there. And all of this sits in this global diversification layer. And if you stop and think about this in any depth, you might change the whole way you live. You might change the way you run the business. You might have a new home base abroad. There are international schools. We live very near a top international school in the Algarve in Portugal. So people are, these things that you previously might have thought of as issues, are they still really issues? If you want a good school for the kids, a lot of places have got that now. You want great hospitals, a lot of places have got that. You've got to think more broadly and try and expand your thinking and expand your geographical horizons, and then see where you'll be treated best. A good place to look for this sort of thing is a guy called Andrew Henderson, runs a business called Nomad Capitalist, and buying his book would be a great starting point. He's an American who's actually given up his American citizenship. He helps other people to relocate around the world. And just to open up your thinking, he does loads of videos on YouTube and on his website, and the book's a great read as well. So you just start thinking more broadly. Maybe not now, maybe it's for 5 or 10 years' time, but you've got to have a plan B. And one of the reasons is, if you look back over the pandemic and the way governments suddenly turned into Chinese authoritarians overnight, you might feel that that's not exactly how you want to live in a show me your papers, please kind of society before you're allowed into the cinema or the restaurant or the theatre. That's not the way I want to live. And you might want to decide whether the place you've been living, especially if it's Canada or Austria or Australia or New Zealand, you might want to think, do I still want to live in a country like this? This is the layer of your pyramid that captures the assets that will give you choices. And after all, what you're working for, why are you running your business? Why are you trying to accumulate wealth, if not to have choices? That is what it's all about. And that's what this layer, which most people never even think about, is all about as well. So that's your global diversification layer, which just leaves us with the pointy end of the pyramid, the high velocity layer. And really, the whole point of this is to say there are some investments which you can have some fun with. They're kind of typically high risk, high return things, usually relatively short term. And this is what I call it, the frothy end of your portfolio, where it's okay to have some fun with these things. This could include things like spread betting, or trading foreign exchange, or trading cryptos, maybe even things like planning uplift on property developments where you've got no idea of the outcome. It's either going to be a 10x return or 0 because it's going to stay as farmland. These kind of things, they're punts, they're gambles. And that's fine, as long as you recognize it's the pointy end of the pyramid. It might be 5 or 10% of your portfolio. It ain't 90% of your portfolio. And one of the problems I find with a lot of people who are broke is that most of their energy and efforts and money has gone into the pointy end of the pyramid, the high velocity layer with a kind of get rich quick mentality that frankly doesn't work. Yes, there are 1 or 2 who've made a lot of money if they bought and sold cryptos at the right time. That's been an exceptional return, but that's not a strategy for long-term multi-generational wealth. So this is where you would have a go at those things if that's something you want to do, but I would urge you to only do that when you've started building up the other layers. So as you consider the whole of your wealth pyramid, part of the thought process is, what is your asset allocation across the different layers of the pyramid? So are you going to put 40% into the bedrock layer, 30% into the passive income, 20% into overseas property, and does that leave anything? Maybe not. 10% into the high velocity. So those are the kind of decisions you can make. And obviously you can start with one view of that and you can vary it as you start to grow your asset base. The point is you're growing an asset base. And also what you can sometimes do is what I call the trickle down effect, which is to say you take the returns from some of the higher layers in the portfolio and you trickle them down to the lower layers. So if you were running a buy-to-let portfolio and you didn't need the actual cash flow from the rents, you could feed those into buying some gold in your bedrock layer or into building an extension on your main home that adds value to that. If you made some money in forex trading, you could trickle that down into owning some shares in a company in a foreign land, to give you some geographic diversification. So you can have a lot of fun with this. Once you start building it up, you can bring the children in to start explaining how you've built this pyramid, how they're going to inherit it, and how they're going to become stewards of it over time. So in another episode, I'll talk to you about some of the things you can wrap around this to protect it, and also how you can try and minimize the tax paid on it. But the main thing now is to get into the discipline of regularly taking money out of your business, putting it into your dedicated wealth account, and from there, feeding it into the assets at the different layers of your wealth pyramid. And if you do this, you'll be well on the way to creating the kind of long-term generational wealth that means you're no longer dependent on the business. And if you do actually get to a point where you could sell the business for a huge liquidity event, you'll already have a structure into which you can feed the proceeds of that sale. And that's one of the most dangerous times in an entrepreneur's journey, when you've suddenly got 7 or 8 figures sitting in the bank account. What are you going to do? A lot of them throw it all at new business ideas and it diminishes very quickly, thinking they can walk on water because they managed to build and sell one successful business. Far better to have this pyramid structure in place to feed it through into the different layers and to make some careful asset allocation decisions within each of those layers that will actually reinforce the wealth you've already built and just really, if you like, subsume and absorb that new wealth from the sale of the business into a structure you understand and you can see why it's going to give you long-term generational wealth. I hope that was useful. I'll talk to you again on another episode of Grow My Business or Sell It. Thanks very much for listening. And don't forget, download your pyramid at grahamrowan.com/pyramid and try creating your own wealth pyramid and see where your starting point is today and how you can build on it in the years to come. I'll talk to you again very soon. Thanks for listening. If you'd like to suggest topics for future episodes, appear as a guest on the show, or invite me onto your podcast, you can get me on graham@grahamrowan.com. Thanks for listening, and I'll see you next time on Grow My Business or Sell It.